Welcome to Socially Responsible Investing Podcast. This is episode 8. I'm Bill Holliday with AIO Financial on the web at aiofinancial.com. In this episode, I'll be speaking with Donna Katzin. She's the Director of Shared Interest. Shared Interest is a 501c3 nonprofit. They're a financial institution that operates in South Africa. They guarantee loans that other businesses and organizations take out, and in that way they're leveraging their money so that people can, so actually more money is getting out into the communities. I asked Donna about the history of shared interest and how it got started.
In the late 80s and early 90s, I was the head of the South Africa program for the Interfaith Center on Corporate Responsibility. And ICCR, which coordinates the work of lots of institutional faith-based investors, was focusing pressure on South Africa to end apartheid. That was the main job. And they did it in a variety of ways. There were dialogues, there was disinvestment, there was divestment, and faith-based and their other partner institutions around the country and around the world were looking to isolate South Africa by pulling investment money out to hurry the end of apartheid, hopefully peacefully. So in 1993, early 94, when it was clear that democracy was going to prevail finally in South Africa and the institutionalized racist system of apartheid was going to fall, those same investors came back to me and they said, we took our money out, but now we'd like to put it back in. Not necessarily in the Johannesburg Stock Exchange, because we know other people will worry about the stock exchange. We want our money to go to work for South Africa's low-income black communities that have been working so hard for freedom for so long. So they said, please, would you just find out who's doing this so we'll know where to invest? I said, no problem. I'll get back to you. The problem, of course, is that we couldn't find anybody who was doing it. And so a group of us together worked on setting up shared interest as an investment vehicle for people around the world to participate in building the new South Africa. And It was about that time that Archbishop Tutu came up with his wonderful quote. He said, the end of apartheid was part one of the struggle, but part two is the more difficult, to make the miracle endure. And he said, first we asked you to disinvest. Now we say to you, invest, make South Africa succeed for the sake of the world. We took him literally.
Wow. Are there other organizations helping out at this point? Or are you still...
Well, there are lots of organizations there are lots of organizations that are working on South and Southern Africa. Some focus on education, some focus on health. As far as I know, we are the major, at least in the United States, organization that's focusing specifically on community economic development and empowering low-income communities of color to sustain themselves, their families, and to help restructure the economy of the nation. I mean, what's interesting is that a lot of people know that freedom was achieved in 1994, or rather, democracy was achieved. But as a street vendor told me at the time, political freedom without economic freedom is not freedom. And so when economic power did not change hands in South Africa, it created a bit of a contradiction, because black people, 90% of the country, were voting. They were the majority. They were making political decisions. But the economic power of the country remained, and to this day remains, in white hands. So that is what we are. That is the reason we continue to do this work, and why the challenges are so daunting, but also so exciting.
Sure. Yeah, economic development is critical. That makes a lot of sense. So could you talk a little bit about the methodology?
One of the decisions that we had to make when we started was how we were going to structure this fund and what we particularly wanted it to do. There are a number of funds around the world that borrow and then re-lend the money they've borrowed. So
right, that's pretty typical.
Yeah, so think community development loan funds or credit unions or even microfinance funds around the world. We thought about this, and we thought that we would be, multi-million-dollar fund, but we were certainly not going to be as big as South Africa's needed in terms of jump-starting the emerging economy in that country. So we thought the most strategic thing that we could probably do would be to move South Africa's own financial institutions, its own commercial lenders, to lend to the 90% of the community, the 90% of the country that was a market, and a market on which they did not bank. So think of 90% of the country, low income, well, black South Africans, most of whom were low income and are still. Think of that constituency as being largely unbanked and certainly not considered creditworthy. We decided that what we would do would be to partly guarantee the loans we'd get South African banks to make to clients they would otherwise consider unbankable. Think low-income women. Think agricultural co-ops. Think people who are building affordable housing and microfinance institutions. The kinds of borrowers who are doing cutting-edge work, keeping their communities alive, keeping the country running, and yet could not get credit from banks because they didn't fit the traditional profile, didn't have traditional collateral, didn't have a credit history. And so what we set up was a mechanism for partly guaranteeing loans of these institutions to low-income communities of color, and also through the South African partner organization that we helped create and work with, making sure that everybody has the technical assistance and support they need to make a success of all of this. By everybody, we mean, first of all, the end borrowers, the people who are starting businesses, building houses, making viable use of their land. Those end borrowers, also the institutions that serve them. So if it's a microfinance institution or a small business lender, making sure that they've got the systems in place to be helpful and successful themselves. And finally, providing support for South Africa's own banks and other financial institutions so that they will learn how to work in the majority market and one day consider it their ordinary business for which they will not need a guarantee. We don't lend. What we do, so let's take it from the perspective perhaps of an AIO client. Client would lend money to shared interest. That money that we borrow then becomes part of a pool of capital that we use to back letters of credit. It becomes the collateral that low-income black South African women don't have. It becomes part of the security that enables a bank to consider lending to a small black-owned business, to a women's cooperative, to an emerging farmer. And when that farmer, that co-op, that woman comes into the bank and the bank says, we cannot give you this loan because you have no collateral, they are then able to say, but we do have collateral. And our collateral is basically put up by our colleagues, most of us overseas, and those colleagues are making possible for us to get this loan because they will share the risk with the bank. And if we, women, co-ops, farmers, new businesses, if we are unable to repay our loans, our colleagues in the guarantee fund will help cover that risk. So we provide the assurance, we provide the confidence through the collateral that makes these banks able to make these loans to the kinds of people they have never considered before, in some cases human beings, but certainly not ever considered clients. Ultimately, the lender's collateral is at risk. However, since we started this 18 years ago, we have never had to call on anyone's capital because of our reserves. So we monitor the risk. We protect our lenders from that risk as best we can, and for 18 years that has worked for us. And in the process, we have reached more than 2 million low-income black South Africans, and every dollar in guarantees has unlocked more than $6 in loans to people that would otherwise be considered unbankable.
Oh, that's great. But so you'd put up collateral. So someone wants to start a fish farm or something, some project, and they need, let's say, $1,000 to keep numbers easy. You'd put up collateral for part of that, or a guarantee for part of it. So you'd put up, what, a couple $100 guarantee?
If we, yeah, so say someone, say a cooperative, and I'm going to use a little bit bigger numbers.
Yeah, sure.
Say a cooperative comes to the bank and they want to, let's say, grow sugarcane, and they say we need 100,000 rand. Let's just say.
Okay.
So 100,000 rand, which is like $12,000, is the amount that they would like to borrow from the bank. The bank says, what's going to happen if your crop doesn't grow? How do we know we can trust you?
Right.
We can't get our hands on your land, so what kind of collateral do we have? We're not so sure we feel so great about this loan. Over the course of the negotiation, which our partners do on our behalf, or the organization we work with in South Africa, Tambani, over the course of the negotiation, it becomes clear that several things will happen. First, that shared interest, with the money it borrows from its investors, will put up, if it is a $1 million rand loan that the co-op needs, we would put up to 75%, so up to 75,000 rand in collateral. Now, often it's less than that. We just did two guarantees for 52 and 53%, but maximum, let's say that's we put up 75%. And if there is a loss, we would pay 75% of it. The bank would pay the rest. Over time, that money, the amount that we put up, decreases. The bank takes more risk, and ultimately, as they did with one sugarcane co-op recently, when the co-op, after the first season, was getting ready to plant its next crop of sugarcane, we said, "So, would you like a guarantee for the planting of your next crop so you can get a loan?" And they said, "Well, no, thank you, because we're actually getting our loan this time without a guarantee. The lenders have seen that we're a good credit risk that we repay, and so we are launched." And that's the objective.
Sure, that's great. So if something happened to that crop, though, your guarantee's at risk, but you're saying it's part of a bigger pool. There's a reserve, so it doesn't necessarily impact the direct lenders? Yes.
So let me explain a little bit how that works. So if there were a loss, say the sugarcane co-op didn't repay its loan fully, say the harvest didn't work out, and they then go to the bank with a partial repayment, and the bank has to recoup the rest of the losses from our guarantee and some other sources because they have other risk protection as well. We would pay up to 75% of the loss from our loss reserve fund. We have a specially designated loss reserve fund. And so the guarantee fund right now, orders of magnitude, is about $14.5 million. The reserve fund is 1.2, and in addition to that, we have a $3 million cushion, a subordinated facility from the Overseas Private Investment Corporation, OPIC, U.S. government agency. So we have over $4 million in coverage on a $14 million fund that would be used before we ever had to draw on any investors' capital. If we get to the point, and this, as I say, has never happened to us, but if we get to the point of having to draw on investors' capital, each investor's share of the loss that they cover is the same as their share of the total fund. It's their pro rata share. So if we have a $14 million fund and an investor has put up, say $1,000, that it would be that what share that $1,000 is of the $14 million, that would be their amount of the loss that they would pay.
Sure. That percentage of loss.
Right.
That makes sense. Are you modeling this after some method? I haven't heard of this being used that often. It's mostly the Grameen micro-lending model. How did you come up with this?
Well, we're interested in using guarantees primarily from a systems change perspective. This is the reason that we've adopted this model. We didn't invent it. There are other financial development finance institutions that have used this, largely in Europe, not so much in the U.S. But the reason that we liked it is because since the challenge of South Africa is how not only to jumpstart communities and empower people, but how to change the systems that have kept people poor and powerless. We very much wanted to do what we could to begin to transform the way South African bankers bank. No biggie, especially. But we felt that by introducing these banks to the majority market, by giving them the technical support that they and their beneficiaries need to succeed, that gradually they will come to understand the tremendous potential of that market that they have not accessed before. And they will begin to help democratize the flow of capital in the country to those communities that need it most. So it's because we don't just want to get money into the hands of low-income people, but we want to change those institutions and those practices that have kept money out of their hands. That in the long term, we felt this was the most impactful model, and that's why we've opted for the Guarantee Fund. It has the greatest social impact, and it has the greatest leverage.
Gotcha. And do people start using other banking services? I mean, do you find that with time they're also opening savings accounts or using other, even insurance? I don't know if crop insurance is something common there, but...
Yes, certainly. And what's interesting is that the banks, which are now beginning to see the potential of at least feeing for services from the Black community, are not so terrible at extending banking services. You know, they're pushing the savings accounts and even the checking accounts and in some cases insurance and microinsurance. And that is beginning to roll out. But credit, that's a big sticking point. You know, they're putting their money,
especially without a guarantee.
Yeah, they're happy to collect fees and they're happy to provide services where they can, although there are many communities in the country still where there are no banks. There were almost no financial services along with other services in many of the parts of the country that were designated for Black people. So in 1994, half the country had no health care facilities as we know them. Many schools were under trees, and banks were just simply not there. So it's the question of extending services has gradually dawned on the banks because it is profitable, it is possible, and many of them do want to make sure their services are extended to those communities. But credit is more difficult, and credit is where you run into traditional banking practices and mindsets, and those are the things that we're out to change.
Sure. And do you charge a fee for providing that guarantee?
Yes, we do. We charge about between 2.2 and 2.5%, but the bank pays this fee for the privilege of the guarantee, and that's for two reasons. One, because the income goes straight to our partners Tambani in South Africa, and they use it to help cover the costs of the services they provide, the technical assistance to beneficiaries and banks. So they use that to help cover their costs. The other reason, though, for charging is that we want to make sure that banks understand there is a cost to these guarantees and that they would do better to simply provide the loans without them. So they have a built-in incentive to do this business themselves without our help in the future. And that's important to us because that's the direction in which we're hoping to move them.
Yeah, and it must be the screening process you have. There must be a lot of demand for this. Is there like a loan size or a guarantee size? But I guess a loan size you're targeting, or I mean, you must be looking, even though the bank's not accepting them because of their risk. I mean, you've got to consider their risk as well.
Absolutely, and we have a very kind of sophisticated set of credit policies which have to do with how we segment or divide up the portfolio, how we allocate risk. Tambani, I mean, our best risk protection really is our partners Tambani in South Africa because every quarter they go to each project. They collect financial information. They do their due diligence quarterly, and they report to us on the risk of each of our outstanding guarantee beneficiaries. So if a company or a farm or a business or a microfinance institution runs into trouble or looks like it might, we then allocate a higher amount from our guarantee loss reserve to cover that particular beneficiary. And we keep really careful watch on this. If it gets to a point, and once it did, where the risk, this is 2008 when lots of people were getting hit by the financial crisis, we saw the risk increase on our outstanding, on the businesses that we were guaranteeing. And we said, based on the size of our reserves, we need not to make any new guarantees right now because we want to make sure we have sufficient coverage to make sure we're able to cover the risk. So we monitor the amount in the reserve fund. We look at the risk quarterly, sometimes more than quarterly, and that's the way in which we are very careful to protect our investors' money, along with diversifying in maximum size. You asked about the typical loan. We typically do not provide a guarantee of more than 10 million rand. So that's about $120,000 is the max, and they go down to maybe $50,000 is the minimum. That's about the size, and that makes it possible for us to diversify and spread our risks among many different beneficiaries and also sectors. The sectors that we focus most on are microfinance, small and growing businesses, agriculture, both primary agriculture and also agriculture-related businesses, either done by individual farmers, families, or communities and co-ops, and low-cost housing.
I guess anything else about the project before we talk about investors?
Sure.
Or how people can get involved?
Yeah. One word about impact, what our impact is, and then one word about why South Africa now. So in terms of impact, I mentioned that we'd reached more than 2,089,000 low-income Black South Africans to date, and that includes the number of people who have received loans for their businesses. That's about 130,000 people who have built or improved affordable houses, low-cost houses. That's about 120,000 people. So that doesn't count all the folks in the family that is living in the house. That's just the people who got the loans. Right. More than 1.8 million jobs created and sustained. So big impact in agriculture, in small and micro enterprise, and in job creation. The vast majority of the people who benefited are women, and just to say, women of color. So we are aiming at women. We are aiming at communities that that need these funds most and have the greatest potential to put their human and economic energies to work to sustain themselves and build a new country. We are particularly eager to ramp up this work at this time. So people in the United States often, lots of people, probably not your investors, but some, have a very short attention span and say, my goodness, 18 years, how come South Africa's not better now? I mean, aren't they free? Is this not done?
We're on to the next issue.
Exactly right. So our investors are typically not channel flippers. They tend to be people who can maintain a longer-term perspective, although it's very exciting to hear about the new directions that we're going in, and so we continue to keep doing new things. But South Africa right now is having a tough time, as people have read in the press. The inequalities in the country have been exacerbated, which is not to say that poverty's gotten worse, but what's happened is that some people are better off than they were. So the overall level of poverty, the people's living levels have increased. The government has been very clear and deliberate in making it possible for people to have support where they're needed. So there have been jobs created. There have been 3 million low-cost houses built. There have about 9 million people now have electricity than had in 1994. About 12 million people have clean and running water out of a population of 50 million that did not have it. So they've done a really, really heroic job of addressing the apartheid economic backlog. However, there are still huge challenges which in 18 years have not been wiped out. Unemployment is still 25%. 1.3 million people still need houses. And the disparities are growing as some people become better off. So recognizing that we want to make sure that this incredible model of peaceful change, reconciliation, and empowerment is alive and well for the world and continues to do its job, not only as an example, but as a motor for development on the African continent. We are expanding our work, and we're also making sure that we and our partners will be there for the next generation. After 18 years, we see a need to invest in the next generation. And so we are on a growth spurt right now, looking to double the size of our guarantee fund, increase the reserves to protect those funds, and begin to expand our work to Southern Africa. So South Africa being one of 14 countries in the Southern African Development Community, we're now beginning to go beyond South Africa's borders, beginning with Swaziland and Mozambique, and over the next few years we'll roll that out to do an even bigger job in the region. We are not in any way cutting back on South Africa. We are scaling up in South Africa as well. But South Africa's health and the region's health are interdependent, and those economies must work for each other to create products, to integrate value chains, and to make sure that that market continues to thrive, especially when Europe and the United States, which have been South Africa's main markets, are not in such financially wonderful shape right this minute. So we are doing our bit to help develop the region as well through this Next Generation campaign.
Sure. What are South Africa's biggest exports? Do they do a lot of manufacturing? They
do manufacturing. Traditionally, it's been agriculture and mining, with manufacturing being a third.
Mining. Okay.
Mining has been huge. That's it. But manufacturing and also services have continued to increase over time.
No, that sounds like great work. And I like that model. I mean, you're funding the organizations that are reaching the poorest of the poor there. I mean, by funding or helping to support the microfinance, you're really attacking the entire financial structure there.
Yes, and I mean, just to give you an example of how sometimes those beneficiaries on the ground are doing incredible work, not just in terms of financial services, but other services. One microfinance institution, for example, that we worked with for a number of years, the Small Enterprise Foundation, had 18,000 clients when we started working with them, and a 99% repayment rate. Now, this is about 7 years later, they have 90,000 clients. They still have a 99.5% repayment rate, just about all low-income Black women in deep rural areas that would have no other source of income or ability to start a business otherwise. But in addition to that cutting-edge economic work, they are also doing cutting-edge work in terms of HIV/AIDS. And in many of their groups where people come together for savings and borrowing every other week, they're also learning about gender rights. They're also building a very, very strong solidarity network where women help each other and support each other. And they're learning about HIV/AIDS management and prevention. And in the study that they did after the first 10 weeks of the implementation of this program, they found that they had not only they were reducing the new incidence of HIV and AIDS, but they had also reduced violence against women by more than 50%, because women knew that they had rights, new to some people. Women had a support system. They had people they could go to and trust to help each other and to help each other survive and work together. And they also had economic options. So very often the economies are just the tip of the iceberg, and the other kinds of value added, the social cohesion, the health benefits, the education benefits, are very much part of what is based on this economic survival and foundation.
Sure. Oh, that's great. And so if people want to get involved, I know they can loan directly through shared interest, just contacting you.
Right, and I can give you, so the website is www.sharedinterest, SHAREDINTEREST.org.
And I'll put a link on this as well.
Yeah, so that's the website, and that's also where to find out more about how the organization works.
Sure.
If folks are prefer telephone, the number is 646-442-0182. And those are the primary ways to get in touch with us. You can also visit Microplace because we are on Microplace, so www.microplace.com. And that's another website.
Another avenue for investment.
Yeah, if you asked about the size of investments for people investing directly with us, the investments begin at $3,000 and there is no maximum. For Microplace, you can invest beginning at $25.
Okay.
And I just wanted to say one thing because this is really interesting for people who have strong social commitments and understand themselves to be part of a larger community. We have some tremendously interesting investors, just in addition to our normal bread and butter investors, the people who are committed that want to see both a social and financial return, and people who care about this work with women, with South and Southern Africa, and so forth. Those individuals have been part of us from year one. So have faith-based institutions, congregations, denominations, religious orders, pension funds, and Catholic healthcare systems. They have also been part of our work for years. But in the last 6 months, there are some just very interesting new investors. One of them is the Ford Foundation, which has made a $2 million loan for our work beyond South Africa. One is a pension fund, the General Board of Pensions of the United Methodist Church. Their investment fund has made a $4 million commitment. The Global Fund for Women has just invested in us because of the synergies with helping women build viable communities, their families, and their lives. And for folks in the Southwest, we thought you'd be particularly interested to know that the most recent commitment is from the Oneida Nation. This is a tribe that was forcibly removed from western New York to Wisconsin, where the so-called reservation is at this point. And the Oneidas, looking at their own history of forced removal, understood the history of black South Africans and their history of forced removal. But they knew one thing in addition to that. They were aware that in the early part of the 20th century, early 1900s, white South Africans came to the United States and studied the reservation system in the U.S. and Canada. Then they went back home, and 30 years later were able to implement it on a grand scale called apartheid, where more than 50% of the people were relegated to these so-called homelands modeled after our reservation. And so the Oneidas, with their 7-generation perspective, are looking not only backwards at the causes of these tremendous injustices, but looking forward and wanting to invest in a way to help reverse them. So
that's wonderful.
We were just thrilled about this as a model and feel that perspective is something that many investors around the country, our country, have a great deal to learn from.
Sure. And you're set up as you're a 501c3?
We are not for profit, and I wouldn't be doing my job if I didn't say that we also need contributions. The contributions that we solicit are for the purpose of supporting the technical assistance that we through Tambani provide for low-income black beneficiaries in South Africa, and also for the work of moving the banks to do the right thing. So contributions can be made to us. We are tax exempt, and so we're a charitable organization. But that being said, I want to just leave investors and others with a quote from Nelson Mandela, who said, "Eliminating poverty is not a gesture of charity. It is an act of justice." So that is very much our perspective, and we would be delighted to work with anyone in your network who shares it.
To summarize, Shared Interest is a nonprofit 501c3 that operates in South Africa. They provide guarantees to organizations and businesses so that they can leverage that guarantee and actually borrow more to help get equity into the community in South Africa. Shared Interest offers unsecured notes, although they do have some protections and a loan loss reserve. They're not insured. The notes can be held or can be purchased through or lent to through Shared Interest directly or invested in through Microplace. They work like a bond. You lend money for a period of time, like 1 to 5 years. You receive an interest on that note while you hold it, and then you get your money back at the end. Please note that we are not recommending this investment. It's not appropriate for everyone. Read the prospectus and discuss it with your financial advisor. That's it for episode 8. The next podcast, we will be speaking with Parnassus Mutual Funds, an SRI mutual fund company. Thank you for listening to Socially Responsible Investing Podcast. I'm Bill Holliday with AIOfinancial.com. Please let me know what you think. Welcome suggestions, comments, questions. You can email me, bill@AIOfinancial.com, or call 520-325-0769. Thanks.